Hello, everyone. It is time for another syndication presented by Self-Storage Syndicated Equities. Today, we're going to be talking about the Lawrenceville self-storage development. This is one that I have been working on for quite some time. Very excited to present it. So let's get right into it. So again, self-storage syndicated equities, we focus on tax advantage self-storage investments with an emphasis on downside mitigation and, of course, social stewardship. So here's the agenda. It'll take about 15-20 minutes. We'll cover the team, why now, the big idea, the numbers and the secret sauce, the offering itself, and then we're going to see if we are a good fit for each other. So here is the team. This is a joint venture between Simply Sold Atlanta, Brandon Rickman, a good friend of mine from, last 8 years or so. He is local to the market. He's the one that found the piece of ground that we're working with. And then, of course, you have myself and Stephen Ware. We have done $228 million in self-storage transactions over the last 6 years. And that encompasses about 53 facilities across 24 states, many of which have been construction or development projects. So we are uniquely qualified for this opportunity. So why now? Well, there's three changing market forces that are creating a short window of opportunity. So if we act fast, we can take advantage of that short window to profit. The first is the changing economic forces. Self-storage is known to be a very recession resilient asset, and it is very resistant to economic volatility. As you can see here, I have a little chart from 07 to 09, the great financial crisis. During that time, the S&P dropped 22%. Multifamily residential were really suffering with a lot of the bankruptcies and foreclosures. Self-storage only dropped about 3.8%. Now, again, this is a study done by National Association of REITs. So this is the large guys. The smaller operators got hammered even more in the multifamily residential space, and the self-storage guys did pretty good. And that's because it is a very recession resilient asset. According to TREP, which is a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage operators in the first 3 quarters of the pandemic, only 3 ended up being delinquent. That is a 0.17% delinquency rate. During the same time during the pandemic, multifamily was defaulting at a rate of 1,800% higher, or 18 times the default rate of self-storage, just to show the recession resilience of this asset class. I'm sure a lot of you guys are watching your stock market portfolios just as I am. It is extremely overvalued and overleveraged right now. I mean, you have some price earnings ratios that we haven't seen since the great financial crisis. So I'm very worried about what's going to happen here pretty soon. I think there's a correction coming. To date, the S&P 500 is up like 18%. That's a ridiculous run up for 1 year, and that's not sustainable. And then, of course, interest rates are improving. We have been signaled that in the September Fed meeting, we're going to get anywhere between 1/4 to a 1/2 point cut, and that's going to only continue going forward. Now, that's going to help significantly with commercial real estate valuations. That being said, we are valuing our exits based on today's Fed rate. So we are not pricing in any type of interest rate drops in the market as a part of our conservative underwriting. The second changing force is the changing technological forces that we're experiencing in the self-storage market. First, there are a big call for a seamless experience. Customers, especially the younger generation, want to handle their storage needs online and with less human interaction. The second thing is that the self-storage technology is evolving and the pricing is getting significantly better. This is allowing us to use things like AI in our pricing discovery, where we actually will use artificial intelligence to see who is willing and able to experience a rent increase without moving out. And we'll actually grade those customers from 1 to 10. And each one of those numbers corresponds to a certain amount of rent increase that we can charge over a certain period of time. And that has worked extremely well across the few facilities that we've already rolled out this Veritex software. The second thing is that the financial side of this is becoming a lot more feasible. So when we first started looking at this software 4 or 5 years ago, the price was just so it was just so high that it just didn't make sense if you're running a facility for a 3 to 5 year exit. Maybe the payback period would have been good if you were planning on holding that facility for 20 to 25 years, but now we're finally getting to the point where these payback periods are actually showing up within the first 1 to 3 years. So really excited about that. And then the last changing force is these societal forces or these social forces. So, living situations have changed extremely since the pandemic, and that's caused this very interesting effect on population shift. There has been this K-shaped recovery. The upper leg did well, started moving out of cities into nicer homes with more space. These are the people that already owned a home, locked in a low mortgage rate, had money in the stock market. Now, the other part of this K-shaped recovery is the lower leg, which did not fare as well. There was mass evictions, mass foreclosures, all of that relief expired already. And you see this lower leg of the economy that did not have stocks, did not have home equity. They're not doing very well. Both of these groups need self-storage. The upper leg, as they're upwardly mobile, they're buying new homes, they're buying more stuff. As interest rates drop, that drives consumer confidence to consume more. And then the lower leg, they're moving into smaller and smaller rental apartments, lack of space. They're going to need self-storage, and it's much cheaper to rent 100 square feet of self-storage than it is to rent an extra 100 square feet of an apartment. The other thing is the living situation. So not only do you have these kind of two generational divides, on one end, you have the baby boomers, the silent generation. These people are retiring in mass, are moving into assisted living facilities in mass. Something like 11,000 per day are retiring. And along with that comes downsizing and the need for storage. And actually, in some situations, there are now assisted living facilities that are requiring that before you get a bed at the assisted living facility, you need to have a self-storage contract, because if you are unable to pay, they want to be able to easily sell the home that you're using as collateral and have a place to put all of those possessions. On the other side of that generational divide, you have the millennials and the Gen Z. They are opting for less square footage, but they want to be in the middle of the action. They want to be downtown. They want to be by the nightlife. They want to be by the entertainment. And they're basically opting for a smaller square footage footprint in their home and then using self-storage almost as an external closet. These are the users that typically want to be within, 5-10 minutes driving time of either their home or place of work, so that they can stop by that self-storage facility often to swap in, seasonal clothes, decorations, outdoor equipment, etc. And then demand is growing. So prior to the pandemic, 1 in 11 people use self-storage. This slide's actually a little out of date. As of Q1 of 2024, that demand is now 1 in 9 people use self-storage. So 1 out of every 9 people use self-storage, and that number is only growing. And then, of course, you can see the average return over the study period, 1994 to 2021. S&P over that period of time returned about 10%. If you go back and look at residential apartment buildings, that's about 14.4%. And then you have self-storage that returned on average over that period 18.8%. And you say, well, Fernando, that 4% doesn't seem like a lot, but you got to realize this is 4% compounded over a study period that's over 30 years long. So let's see what that looks like if you had $100,000 to invest and you left that $100,000 invested in self-storage that entire time. So if we invested in 1994, $100,000, what would that value be in 2021? Well, as you can see here, the S&P, it returned a modest amount. If you actually look at, that 1.5 million, if it was in residential, you'd actually be able to double your money. And that's because of this big run up during the pandemic, when people were really trying to lock in low rates, but also trying to catch a falling knife because supply was dwindling and people were they wanted to get a place that had more room, had the ability to work from home, had the ability for the kids to work, to go to school from home. Now look at the difference between residential and self-storage. That 3.7 now is over $10 million. So that is that power of compounding interest, 18.8% average annual return over this period of time. So what is the big idea? Well, the big idea is to purchase or build facilities in affluent growing markets with high rental rates and high demand. Our strategy is typically to get into a large top 50 MSA like Atlanta, but not be too close to the city where the land is super expensive, the properties are already super expensive, and there's no yield. So in this situation, we have gone to Lawrenceville, Georgia, which is an affluent suburb of Atlanta. As you can see here, how close it is to Atlanta, maybe 40-minute drive. If you zoom in, what you can see is that we're on a major thoroughfare. This is actually Lawrenceville Highway. And you can see that it is roughly halfway between Atlanta and Athens, Georgia. So major thoroughfare back and forth, especially for the people that are, going to college, visiting people that are going to college, or work in either of those two areas. This facility is located on US 29, which is Lawrenceville Highway. And as a part of the negotiations with the city, we were able to put in a dedicated deceleration lane right off the highway. So we have access to 28,000, 29,000 cars per day, literally driving right back past the curb cut of our self-storage facility. It's also a few doors down from the Walmart. So this location will be a significant benefit from a vehicle traffic and prime visibility standpoint. One of the other things that's interesting about Lawrenceville, Georgia, is that the zoning and entitlement process is an absolute nightmare. So like I said before, I've been working on this project for over 2 years now. That is a good thing for you guys now because we are already through the entitlement and permitting process, which means if any competitors try to come in, it's actually a very high barrier to entry for those competitors. We've actually already been approached by 2 of the publicly traded REITs. They wanted to buy us out of the land because they realized how difficult it was going to be to get through the entitlement and permit process. And they wanted to just buy a piece of ground that was already done. This is the trade area in Lawrenceville around our self-storage facility. Each one of the colors represents a 5-minute drive time. So 5, 10, and 15-minute drive time from our facility. As you can see, that covers a large swath of this affluent submarket, these affluent suburbs of Atlanta. This is the site plan for the facility. As you can see, most of the buildable square footage is up front. We do have some creeks in the back, so we had to do a lot of mitigation for that. As a part of our social stewardship component of our business, we made sure not to affect any of the wetlands. And we're actually putting solar panels on top of the facility. This is a very interesting structure, and I'll show you why. So since there's a creek towards the back, the elevation dips quite a bit. And what we're able to do, it actually worked to our advantage. We're able to put up a 3-story structure, but it's technically like a 2-story with a basement. And so what you're seeing on the front here is the side that faces the highway. This piece is 2 stories. So basically we have a first floor and a second floor. Typically the first floor is going to be the unit or the level that commands the highest rents per square foot. But because we built into a slope, our basement unit actually has a walkout basement door. So we actually have 2 first floors now on this project, which allows us to charge more rent per floor than what we'd usually be able to do with a flat piece of ground where someone would have to get on an elevator to reach floors 2 and 3, as opposed to being able to drive up to 2 of the floors on that facility. Our brand is Social Self-Storage. Let's talk about the market demographics here. Here's those drive times I was telling you about. Really fantastic numbers. Typically we want to see within a 15-minute drive time about 60 to 100,000 people in the population. As you can see here, we're way above that. There's 150,000 people just in a 10-minute radius. In a 15-minute radius, almost 320,000 people. And then the second thing we want to look at is what is the ratio between rental housing and permanent households. We usually want to see at least 25% of the households be rental housing because those are typically more transient, typically use more self-storage. As you can see here, 46,000 of the 107,000 households are rental housing units, and they're luxury rental housing units. So really good numbers for us. Like I was mentioned before, the average vehicle per day counts on one side of our site, you're at about 20,600. And then at the other side of the site that ties into the highway, you're at about 29,000. So who is a good fit for this project? Well, investors needing to roughly double their money in the next 3 years. And I'll show you where this range comes from. It's based on the cap rate table. Investors who are dissatisfied with volatile investments such as stocks or rapidly depreciating assets such as cash. If you look at the value of the dollar pre-pandemic to post-pandemic, it's lost almost 20% of its buying power over that period of time. So, massive inflation. All inflation is devaluing of the currency. And then, of course, Lawrenceville self-storage is an offering in a class like self-storage that is recession resilient in a growth market. This is huge. So let's look at the overview of the project. This is a Class A state-of-the-art facility. It is multi-story with temperature control across the entire facility. Like I said, the social stewardship side of it, we are putting solar panels on the roof. Not only does that help us secure better financing, lower interest rate, higher leverage, it also, is good for the environment, and it will reduce our utility cost, which when we go to sell will help us get a larger valuation because self-storage is valued based off of the cap rate or its earning potential. This is going to be 87,000 square feet or 863 units. So this is a big boy. This is exactly what the publicly traded REITs are looking to buy from us. And then high physical occupancy in a growing market. So all of the competitors are at 90+% occupancy. What that typically means is that there is pent-up demand in that market. When you go into our investor portal, you'll be able to look through the feasibility study. It's almost 100 pages long, third party that was hired to do that for us. What he found was there's almost 330,000 net rentable square feet of unmet demand in this market. So we're coming in and we're not even providing a third of the unmet demand here. Very high visibility on a major highway right next to a Walmart. We couldn't ask for a better location. 4.5 acres of prime land. Now, this is one of the things I need to stop and just, really congratulate Brandon, our partner, on finding this piece of land. Right now in the self-storage market, prime self-storage land is selling for $300,000 to $500,000 per acre. This is 4.5 acres. We bought the entire acreage for $500,000. So just to show you how good of a deal we got on the land itself. In real estate, you make your money when you buy, not when you sell. And then, painstakingly over the last 2 years, we had acquired it, entitled it, and got it permitted. So we are ready to go. Here are the numbers. These are going to be very high level because I don't want to bore you in this section of the video. If you're a good fit, if you like the deal, you can go into the investor portal where there's in-depth analysis. There is the bank underwriting. There is the third-party feasibility underwriting. There is our underwriting. You can compare all three. We took the most conservative of all of those reports. So we're getting $10 million of debt on this facility. Equity is $4 million. Total project cost is $14 million. Now, one of the ways that we limit downside risk or mitigate our downside risk is by not using bridge debt. You're seeing a lot of these other syndicators are in a lot of trouble right now because they took 2 to 3 years of bridge debt, construction debt, and then assumed they would be in a better market or the same market they were in to refinance. And now you're seeing a lot of capital calls. You're seeing a lot of projects being handed back to the bank, especially in the hotel, office, and multifamily space. Our debt on this project is a 27-year debt. So we get 36 months interest only, and then we get another 24 years fully amortized, just to show you how we mitigate risk on all fronts. Now, the plan is to sell it, once the property becomes 90% occupied. But if any hiccups come along the way, we won't be forced to sell at a loss. And then the projected sale price is 18 to 20 million. I'll show you where that range comes from based on the cap rate analysis. So here are the stabilized operating numbers. Total revenue, 1.38 million. That's using today's rental prices. So we're not assuming any, rent increases from inflation in these numbers. Operating expenses about 360,000, again, using today's numbers, but we did put in a 3% increase per year in operating expense inflation. That gives us a net operating income of just over $1 million. Now, I called multiple brokers that we've worked with in the past, and they said, today, Fernando, if you were to bring this out to market today, August of 2024, we can probably sell this between a 5% and a 5.5% cap rate. This is not assuming interest rates go down at all, which of course always gives a bump to commercial real estate. So let's see what that cap rate matrix looks like. If we were to sell between this range, you'll see if we sell between a 5% cap rate or a 5.5% cap rate, that's where your 18 to $20 million range is coming in. We're running our numbers based on the higher part of that range. So a lower valuation, 5.5, which would give us about an $18 million sale price. Now, of course, if interest rates start going down, typically cap rates will trend with those interest rate decreases. So let's say we get a 50 basis point decrease by the end of the end of the month, or the end of the year. That is going to give us the ability to kind of go up this cap rate range and get into that, that 20 to 21, maybe even more, $22 million range, but we're not assuming that. What is the secret sauce? Well, off-market deal sourcing is important. If we go to the brokers, they strip all the value. I don't want to go to an auction house that has 100 people bidding. I want to go to the auction house that only has me at the table. Tax advantage to reduce your annual tax burden. This is because of how we do our cost segregation studies and then how we actually design the building with our cost seg engineers to make sure that we can use the max amount of bonus depreciation. And then multiple exit strategies to mitigate downside risk. Like I said, we've already been approached by 2 publicly traded REITs to buy the land. We can sell it at certificate of occupancy. We can sell it once it becomes break even. We can also wait, which is our plan, until it's fully stabilized and then sell it at 90% occupancy. And then, of course, using that high cap rate, that 5.5, very conservative, this is a 1.84 times multiple on your equity in 3 years or less. So this is the offering. Depreciation, you're getting between 22 to 37 cents per dollar invested once the property is put into service. This number can go up if the new tax bill that is sitting in Congress gets passed. Probably will go back up for a vote next year, which will push the bonus depreciation from 40% back up to 100% retroactively. So that will almost double these numbers. Target IRR, 22 to 30%. That's using a 5 to 5.5% cap rate range. And then 1.84 to 2.23x multiple using that 5 to 5.5 cap rate range. If it goes lower than that, then you're looking at close to 2.5 times your money in 3 years. So here's what the offering looks like, depending on your range. The reason we limit the investment to 900,000 is if you go above 900,000, then the bank is going to require you to sign on the debt. So if you're unwilling to do that, don't invest more. If you are willing to go over 900,000, we'll actually sweeten the deal. We'll give you some of the general partner equity for being a loan guarantor on the loan. But let's just say 100,000. So if you invest 100,000 in the year it gets put into service, you're getting at least $22,000 in tax offset from that bonus depreciation. All distributions from sale and cash flow will come out to about 184,000. Subtract your initial investment, the return of capital of your 100,000. That means your net proceeds will be 84,000. That's a 1.84x. That's assuming we sell at a 5.5% cap rate, which is on the low end of the range for valuation in today's market. So are we a good fit? Are we a good fit for each other? All money is not created equal. I want people that are professional investors. I want to make sure that we get along as individuals. So do our core values align? Accredited investors only. That's 200 to 300,000 a year in income, if you're single or married, respectively, or you have $1 million net worth, not including a primary residence. Those are the two main ones, but there's actually another 18 categories that you can qualify as an accredited investor under. And then, like I said, this opportunity in this market will be short-lived. A lot of the publicly traded REITs are already kind of swimming around trying to see if they can get a finger into this market. Of course, they're going to have about 2 years to deal with the permitting entitlement process. So if we act fast, we can profit. And then, you know, we need a decision in the next 10 days. Once you see this, once you go through all the paperwork and the due diligence, you know, don't dilly-dally. Just shoot me a quick yes or no. If it's a no, that's totally fine. If it's a yes, come on board. We'll get all the paperwork done for you. So what are the next steps? If you have any questions after reading all of the due diligence material, feel free to call or text me or shoot me an email, whatever is easier for you. There should be a button like right above this video here that says investor portal. Click that. Log into InvestNext if you already have an account. Thank you, repeat investors. We really appreciate you. If you are new to working with us, you're going to have to click on that register button at the bottom when it asks you for your login and password. I recommend using your email address for the login. And then once you come in, it'll give you the option to start filling out all the paperwork and looking through all the due diligence materials in that investor portal. Make sure to have your advisors review for you. And then once you're ready to go, complete the subscription booklet, fill out the W-9 so that we can wire an ACH to you, review the wire instructions, and then send that accredited investor verification. Typically, the easiest thing to do is either have your CPA or your attorney fill out a letter saying, yes, I'm familiar with my client's accreditation status. And then, of course, wire funds in the next 10 days. Here's a QR code that has all my contact information if you want to save it in your phone very quickly. And then if you have any questions, please reach out. Our disclaimer, you know, this is a self-storage investment. It's a syndication that carries risk. Please read this disclaimer, pause the video, and then once you're done, you can get along to the investment portion of the video. So that is it. Thank you for taking the time. I'm sorry we ran a little bit over here, but hope to see you guys in the deal. Thank you very much.